because I've received a lot of messages from a lot of you asking me to assist with a full lecture on Goodwill. So I'm going to do this short video on Goodwill to break it down for you so you know everything that is important for your exams on Goodwill, and especially for the people who might not be quite comfortable on financial reporting. So I'm breaking this down for you. Yeah, so this is how we're going to deal with it. But where I want to start from is when we are talking of, remember, we're talking of business combination. That's where we're starting from. Yeah, we started this paper with consolidated financial statement. And we always have to prepare consolidated financial statement when a company has control over another company. In that case, there's an acquisition. There's a business combination. Acquisition is the same thing as business combination. Yeah. So because of that, we're talking about consolidated financial statement. And when we talk of acquisition, there's usually a purchase price, which is the cost. Remember, this is the same thing as cost. Yeah. Purchase price is the same thing as cost. And at the same time, there is net assets that you acquired. Yeah. So this is what is acquired. Yeah. This is what is acquired. And this is your payment. This is what you paid. So the first question is, why are we talking about Goodwill? Please note that Goodwill arises whenever the purchase price is not equal to net asset acquired. So whenever what you paid is not the same thing as what you get, there is a goodwill. The question is now what type of goodwill it is. And the type of goodwill can now be positive goodwill or negative goodwill. Remember, because we said goodwill arises when the purchase price is not the same as the net asset. When is it positive? It is positive whenever the purchase price is more, which means it's greater than the net asset acquired. And the opposite is negative goodwill, which means the purchase price is less than the net asset acquired. And you can see, positive goodwill means that you are paying more than what you have been given. Why will you do that? You are doing that because you believe that there is intangible, let me put it out, you cannot hold it, it's not physical asset, but there's an intangible economic benefit. That is, you believe that there's something that you cannot lay your hands on about the company. It's beyond the asset. That is why you are willing to pay more for that asset. Imagine an asset that is worth 20 million and you are saying, I'm happy to pay 23 million. It means there is another benefit that is not physical, that nobody can touch it on that asset. However, you believe that benefit exists. And an example is customer base. You cannot really put value to customer base, existing customer base of the business you are acquiring. So most likely you will pay more for that business, more than the fair value of the asset that you're acquiring. Because the business has been existing for years, the customer has been existing, and you're coming to just acquire the business based on the valuation of the asset and liabilities. There is more to that business, most likely. So that is a positive kind of goodwill. And negative is when you are saying, I know you have done the valuation of this company to be this huge. However, I am not willing to pay that much. So which means you are paying less than the value of the company. And that is called bargain purchase. Because you have got a very fantastic price, you are paying less. And that is why it's called bargain purchase. Because you are making money already. You are making profits on the day of acquisition. You are able to negotiate so much amount less than the asset. The asset is worth 20 million, but you negotiated so good that you were able to buy it for 15 million. So you've already made profit of 5 million on day one. And that takes me to the accounting treatment, because the accounting treatment for these two differs. If you have a positive goodwill, is an asset. This is a non-current asset. And it is recognized at cost. Please note that there is no amortization on goodwill from acquisition. No amortization. However, you must perform annual impairment test. I'm going to speak more on this when we start looking at standards. IAS 38 touches this. So we must perform annual impairment test to be sure that there has not been impairment on the goodwill, which I'm going to touch soon, even on this recording. However, for bargain purchase, this is recognized as income straight away. It's a profit on acquisition. So which means in terms of entries, when you are posting debit goodwill here, recognize the goodwill. Yeah? You're going to be no goodwill to recognize it. Here you are crediting your income for that goodwill amount. Remember, the entries, there will be payment times. Yeah. Payment mode will be recognized here. Yeah, and you're also going to recognize all the other, if you remember all the adjustment entries on the day of acquisition that I gave you in the previous video. Yeah, everything comes to play here. So it's a credit to income here, whereas a debit to goodwill here. So here there is no goodwill. Yeah, even when you have credit to payment mode here, yes, you're still going to have other debit going into the investment in subsidiary. Yeah, which you're also going to have here. Right? So credit payment mode is constant for both of them. Investment to subsidiary is constant to both of them. But remember, we said goodwill exists when this guy, is not the same as this guy. So the difference is posted into goodwill. When it is positive goodwill, it comes on statement of financial position. But when it is negative goodwill, that difference is posted into P or L. That is the difference. So you can see this is constant. But the difference between the two will go into different accounts depending on the type of goodwill that you have. And that is it with the accounting, but it's not complete yet until we look at the impairment. Then I'm going to quickly do a calculation for you to just break it down even further so you understand it perfectly. Now, let's talk about impairment. When do we say there is an impairment? Impairment arises always when the recoverable amount of an asset. Remember, impairment is only relevant for an asset. When the recoverable amount, which is the amount you have put in your mind that you'll be able to benefit, your economic benefit from that asset, is the recoverable amount, what you can get from that asset, when it is less than the book value. Your book value is your financial statement value. So when the recoverable amount is less than the book value, then you have an impairment. Like I said, when we look at IS 36 and IS 38, I'll go into much more details on impairment, but this is just for Goodwill. So I'm not going to go into details of value in use and fair value less cost to sell in this recording. When we look at the standards individually, we'll go into those details. You don't need those details now. Yeah, so let's stay focused. Right, so impairment arises when recoverable amount is less than the book value. Then you say there's a goodwill. And in that case, an impairment rather. And in that case, that impairment is a loss. Impairment is always a loss. And you know that a loss will always result into the debit to profit and loss account. So usually, the entries you expect is when there is a loss, we're going to debit P&L, which goes to your retained earnings, right? And you're going to reduce the goodwill by that impairment amount, because impairment means that the value of goodwill has been eroded. The value of goodwill has been reduced. You've lost some value from the goodwill. That's what it means. Now, the most critical part of this impairment is the way it can be tested. Because the way you post these debit parts can vary. It's not always just to retain earnings. The only part that is constant is this part. The credit to goodwill on the statement of financial position is easy. You just reduce that goodwill amount. Easy. However, for the other leg, the other debit leg, it can vary. Sometimes it's only retained earnings. Sometimes it's both retained earnings and NCI. And what I want to bring out to you quickly is when does it go to retained earnings only, and when does it go to retained earnings and NCI. And I will remind you quickly. When we spoke about NCI, I told you that NCI can be measured in two ways. I said NCI can be measured at proportionate of net asset and it can also be measured at fair value. Those are the two ways, either as a proportion of net asset or fair value. If it is measured at proportion of net assets, then it is the easiest form. In that case, when there is an impairment in goodwill, all of the debits will go to retained earnings, and all of the credit, as we know, will stay with goodwill. However, if the question says that NCI is measured at fair value, then this will not work. Then you need to split the debit into two. So a part will go to retained earnings, which is the parent proportion, and a portion will go to NCI, which is the NCI proportion. The credit will always be constant to go to goodwill. So that is the way you treat impairment in goodwill. So you must understand that possibility. It depends on the way NCI is being measured. And you can look at it. You will see it. Let's look at the question. Why NCI should be getting some form of goodwill impairment when it is measured at fair value? Before I go into an example, the reason, first of all, is because when you measured NCI at proportionate of net asset, NCI doesn't get any goodwill. Because what you are saying is that if net asset, take for instance, is 200 and NCI is 20%, the opening NCI will be 20% of 200. So if net asset is this, so the opening NCI will be 20% of 200. And what's 20% of 200? That is 40. Right? Then what is the net asset of NCI? The net asset of NCI is also 20% of 200, which is 40. So the fair value of NCI, which is like, I don't want to use the word fair value now, the price of NCI on acquisition is 40, because that's how it's been measured. It's measured at proportional of net assets. The net asset of NCI itself is 40, so goodwill is 0. So any goodwill that arises from a situation of like this, obviously is coming from the 80%, which is the parent part. And that is why NCR doesn't get any impairment when when a proportion of net asset approach is being used. But we'll look at a proper example now, but I just quickly use this to exemplify it, how and why. Now, let me take you to a question. I have a question here that I want to just... Yeah, I think this is where we're coming from. Yeah, let's look at this. So, and I'm going to still work it down like this so that we follow it in those two perspectives. Look at this question. Patrick acquired 70% of the shares in Stanford for $16,000 on 1st of August 2005, when Stanford had net asset of $20,000, including retained earnings of $12,000. At acquisition date, NCI had fair value of $6,500. So they give us the fair value of NCI acquisition date. On 31st of 2006, which is year end, Goodwill was impaired by 20%, so there's an impairment. So they gave us retained earnings at the year end for both Patrick and Stanford, and we need to calculate the Goodwill, retained earnings, and NCI at the year end. So let's deal with that quickly. Let's start with the Goodwill. How do you calculate Goodwill at year end? Goodwill at year end, remember, for whatever we're doing, Goodwill at year end will be equals to opening, because we have said that Goodwill is never amortized. The only thing that can reduce Goodwill is impairment. Right? So it's opening less impairment. And that will give us closing. Right. But the question is, what's our opening Goodwill? We don't even know it. So let's deal with opening Goodwill for both scenarios. Opening Goodwill. So which means, first of all, we need to determine the cost. And we need to determine the NCI. Opening NCI, remember. Then we get the total acquisition cost. Then we get the net asset. So the cost, they've told us that cost was 16,000. However, that's 70%. That's just for 70%. So the remaining 30% is the opening NCI, which will be 30% of net asset, because this column we are using proportionate of net asset. This column is a fair value assumption that we're using. So we'll see how the values can be different. Right. So which means 20%. So that will now be 30%. So NCI will be 30%. Proportionate of net asset, because 70% was acquired. So 30% of net asset. What's our net asset? Net asset was 16,000. Is that what they give us? No, net asset is 20,000 here. Look at it. This is acquisition cost. So 30% of 20K, that's 6,000, which means the total cost of acquisition is 22,000, and net asset is 20,000. Net asset 20,000. So under the proportionate method, you can see Goodwill is 2,000. And what I was trying to demonstrate earlier is that because it's proportionate of net asset, even if we don't include NCI, the Goodwill will still be 2,000, because NCI doesn't have any Goodwill here because it's proportionately measured. Think about it. Cost, let me show you, is 16,000. If we do 70% of 20K, which is our net asset, then it means we acquired 20,000 multiplied by 0.7. That's 14,000. That's 16,000 minus 14,000. That is 2,000. You can see the same thing. So this is parent. If you try to do for NCI, you see that NCI is 0. Cost NCI is its measurement, which is proportionate, 30%. of 20, and that's 6,000. Yeah, the net asset of NCI will also be same way, 6,000, and that is 0. And the total goodwill will still give you 2,000. Yeah, so that's just to show you that quickly. But now let's look at the other way around when fair value is being used. If fair value is being used, the cost is 16,000 of parent. NCI is now at fair value, and they've given us the fair value of NCI to be 6.5. So which means we're going to use 6.5 as opening NCI, and that will give us 22,500. The net asset acquired is 20,000, and you can see goodwill is different, 2,500. So it's different from what we have under here. So we have our opening goodwill. The next thing is to get our impairment. And they said the impairment was at 20%. So here it will be 20% of 2,000, which will be the 20% of 2,000 for proportionate side, and that will give us 400 impairment. Whereas if it was fair value measurement, it will be 20% of 2,500, and that will be 500. You can see the figures are different, so you need to be careful in exams to use whatever the question has asked you to use. You can see that different figures you will arrive at, right? So now the question is, how do you post this impairment loss? Yeah, obviously here is very easy because proportionate, I said everything goes to retained earnings of the parent. So 400 and credit goodwill, 400, done. But here it's going to be different. You're going to have to debit, but the credit of goodwill is still constant, 500. So this will take 70% for parents, and that goes to retained earnings. So 70% of 500 is 350, and the remaining 30% of 500 is 150. So this is retained earnings. I need to write it clearly because this part is very important. So you're going to debit retained earnings for the 70%, and NCI takes the 30%. So that is it for impairment of goodwill. And that means the closing goodwill will now be opening minus impairment on each side. So this one, the closing goodwill will be 2,000 minus 400, and that will be 1,600. And here it is 2,500 minus 500, and that is 2,000. So that is closing goodwill. And retained earnings as well will be different. Retained earnings will be different. You look at it. Here, the opening retained earnings. Check. How much has the retained earnings been impacted? In this question, for this side of the column, where we are talking of proportionate, here, you see that only 400 is going to retained earnings. But here, 350 only is going to retained earnings. So it's very important we take note of that, because they've given us Patrick retained earnings to be 67,000. So we know that Patrick is 67,000, and we need to have that for sure. But let's get the post-acquisition retained earnings first. So retained earnings of Stanford, because that's what we need to add. If you remember, we usually get it in the previous video. Opening, they gave us is 12,000. Closing for Stanford, they gave us is 15,000. So which means post-acquisition profit is 3,000. So that's what we need to deal with for both of them, right? We know our post-acquisition profit. So retained earnings now, to get retained earnings, remember the formula is you have to do the parent plus percentage proportion of parent on post-acquisition. retained earnings. Less any impairment, for sure. Okay, so in this case, let's apply to the same column in those two scenarios. Here, so we're going to have 67,000 plus 70% of post-acquisition profit, 3,000, then less 400. And here it's going to be 67,000 plus 70% of 3,000 minus 350. Remember, that's the only thing going to retained earnings, 350, not the whole of 500, because of the way the NCI is being measured. So 0.7 times 3,000, that's 2,100. So we need to take 2,100 minus 67,000. Then we need to take away 400. And we have 64,500. So we have that retained earnings. And we do the same thing for the other side, 67,000 minus 2,100 minus 350. Oh no, sorry. That should be 67,000 plus. Sorry, that's a mistake. 67,000 plus 2,100, then minus 350. That's 68,750. I need to check this one. Apologies. So that would be 67,000 plus 2,100, then minus 400. 68,700. So that would be 68,700. Right. So that's the closing retained earnings. Yeah. And for NCI, it's always opening NCI plus post acquisition. Yeah. Percentage NCI of post acquisition reserves. Yeah. And that will give you closing. So now we have impairment, so we need to do also minus impairment. So I'm including that there. So now let's go for it. Opening NCI will be different on both sides. On the proportionate side, our opening NCI, we got it to be 6,000. Here, fair value is 6,500. So opening here is 6,000. Here is 6,500. Percentage post action is 30% of 3,000. So that is 30% of 3,000, which is 900. So we'll add 900. Then we'll deduct impairment. Here there's no impairment because it's proportionate. But here there is 150 impairment that is attributable to NCI. So this one stands as 6,900, while this will be 6,500 plus 900 minus 150. See, 7,250. So invariably what you are saying is that you have extra. You see, there's a goodwill from NCI, because you can see when we calculated goodwill, it's 2,500 here, but it's 2,000 here because there's an extra goodwill from NCI. So that is what you're actually trying to impair by taking that 150 from the NCI and start suffering the extra fair value that it benefited on the date of acquisition. Right. So that's a question to just drive it home, and I believe that has done good justice to goodwill. If you still have additional question, please remember You can put a comment on the video and let me know if there are so many requests. I can do more if you want me to do more. If it's clear, let me know it's clear. Continue to like, share, subscribe, and let's keep going. Thank you. Bye.